Blaze Fabry from ChinaVestor.com, and today I'm going to talk about the shale oil industry, or at least four companies that are listed in the New York Stock Exchange. And the question really is why Whiting Petroleum, ticker symbol WLL, is not trading nearly as expensive as its peers. As a matter of fact, the Whiting Petroleum, WWL, going forward, is trading at 14 times earnings compared to 23 times earnings for Continental Resources, ticker symbol CLR, and Kodiak Oil and Gas, ticker symbol KOG. P for Oasis Petroleum is ticker symbol OAS, is 19. So WLL is 14, the other guys are like 23 or 19, and this is what I did. I looked at the income statement, balance sheet, and cash flows, and I think I found some very interesting answers you want to know. First of all, income statement, just the major or the most important findings. The top and bottom line growth, in other words, revenue and earnings growth, is really not there for Whiting Petroleum. The company went from being a 920 million company, this is in sales, to 2.7 billion in the 2009-2013 time period. This is the last 4 years. So this is like a 300% increase, like, or 3 times. The same time, Oasis Petroleum was a tiny $37 million company in sales, went to 1.1 billion. So it's like a 20-fold increase. Kodiak Oil and Gas went from a tiny 11 million company to a huge 950 million. And Continental Resources was 630 million and jumped to 3.8 billion. So while Whiting Petroleum grew from 920 million, so almost like a billion, to like 2.7 billion in the last 4 years, Continental Resources went from 630 million, a little bit less than the 920, to 3.8 billion. So it became a much larger company, Continental Resources, at the same time as Whiting Petroleum. So that's the reason why WLL is really not as favored by the market. That's the bad news. The good news is for Whiting Petroleum compared to the others, basically, is that the balance sheet is really not as bad, or not as highly leveraged. I shouldn't say bad. It's not as highly leveraged than Kodiak or Oasis. As a matter of fact, debt to assets ratio for Whiting Petroleum is 29% compared to 58 and 57 for Kodiak Oil and Oasis Petroleum, respectively. Debt to asset ratio is 38% for Continental Resources, which is just halfway in between the 29 for Whiting and high 58s, 59s for 57, 58s for Kodiak and Oasis. So in other words, there is a chance, there's a good chance that Whiting can take on more debt if needed. Now, as far as cash flows go, what I found is interesting is that Whiting Petroleum operating cash flows are good. The company generates most of its capital expenditure. Capital expenditure via operations, and needs only a little bit of borrowing to fund growth, which is different from Oasis Petroleum and Kodiak, that these two are like heavily leveraged, and they really need additional funding sources to be able to grow the way they did in the past. Continental Resources is another company, though, that funds most of its growth organically, operating cash flows. The company generated 2.4 billion cash from operations in 2013 and spent 3.8 billion on capital expenditure at the same time. So the the gap between the two is 1 billion, and that's where it went to the debt market. But again, even 1 billion a year for a company like this size is really not bad, especially concerning that its current equity to debt ratio is very reasonable. So all told, this is just the cream of the crop of my findings. Next time I will talk a lot more about the income statement alone than about the balance sheet and comparative analysis of the cash flows as well. So please come back to ChinaVestor.com and see what we have to say in our next video about the very interesting and promising shale oil industry. Thank you for your time, and come back and visit us at www. right here, ChinaVestor.com. Thank you.